Okay, good afternoon, everybody. This is Jim Kinney for Friday, the 21st of June, triple witching, I guess, today on 2019. Before we get started, I always say to people that past performance is not necessarily indicative of future results, and that short-term trading and option trading involves substantial risk of loss. So make sure you consult with your clearing firm, your broker, your financial advisor, and your good common sense before you even think of any type of trading at all. Okay, this week was a very wild week. I gave you a mid report on Wednesday, but I'm giving you a follow up here today. What we saw this week is obviously the Fed met and they decided to take the word patient out of the equation of their talk, and also said they were willing to cut rates if, in fact, things continue in a softening patch. I think this week's meeting we have coming up on Friday at the G20, and also with Mr. Xi and Mr. Trump, President Trump, should be very interesting to have a big effect on it. The market seemed to be selling off as we went into the end of the day. As you can see right here, it went from 2680 down to almost 2700 and turned negative at the end of the day. Again, on Wednesday, I brought to your attention that I'm going to put the S&P up here for you. I brought to your attention and reviewed my take on the market, my opinion and my views, which is what I do at this broadcast, is give you my opinions. And basically, I just reiterated very briefly the broad strokes in that when we hit 2350 in December, moving averages were up at 2750. I indicated the possibility of going back toward those averages because snapping back is what sometimes things do. And of course, when Powell went from hiking to pause, that's all the market needed to snap back to the 200-day moving average. Then traded between 2800 for a while, and then the next target was the highs of around 2950. This is not an exact science, so it went to 2964. I don't consider that some super duper new high. Okay, so basically it's come back up to the area where it's failed the last two times. So that's why you got to keep an eye on things, because enthusiasm, in my view, is a rocket ship right now. And again, there's a lot of proof that has to go into the pudding. With regards to what are people screaming? They're screaming that interest rates have got to go down, 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 down. Fed's got to cut. Fed's got to cut. Okay. Well, what the Fed has said is we're going to look at the information. Yeah, they're still expecting a July cut. Yeah, some guys are talking about 50 points. But what I'm seeing is this. I'm looking at an economy that has retail sales pretty darn solid. I'm looking at the Fed, Powell, just coming out this week saying household spending is quite good. Right off the bat, that tells me 2/3 of the economy, 70% of the economy, which is consumer spending, is not looking so bad. Now, that's very good. Second thing is the big concern is inflation and the business spending. Okay, well, who's going to do a lot of business spending when you're involved in a crazy trade war that is hurting just about everybody? Nike, not Nike, but New Balance came out. They make all their stuff here in the U.S. They're getting hurt by it because some of the materials they get come from China, and it's becoming a problem. There was another bike manufacturer who was saying the same thing. They get stuff out of China. Problem to do that. Boom. It's affecting even the local companies as well. So again, when these things come off, and then some more resolution, you're going to find business spending, I'm sure, pick up quite nicely. Second thing is inflation. I don't know. The inflationary numbers don't seem to be very high, but as I go around living my life, I don't see prices collapsing by any means. PMIs around the world are lower, but they're still right around 50. And the last time they did a preemptive strike in the 90s, PMIs were in the low 40s. So we're well aware away from that. So again, I think betting pot that the market's going straight up and betting pot that interest rates are going to zero, may not be the best bets in the short run. We'll have to see next week. This week's high of 29.64. Let's see if they can take it out. If they can't take it out, then there's a chance that you would see a little bit of reversal, because the 200-day average is in the high 2,700 and the 50-day average is in the high 2,800s. Okay, let's turn towards a couple of things also that have me concerned. Remember, the moving averages look good. Obviously, the price action has been good. The Fed looks like they're ready to help. These are all good things. But things change, and sometimes people get over enthusiastic and they get in a little bit emotional. I think they got emotional this week. So let's take a look at a couple things that are not confirming that we're going through the roof. Transports. Transports right now are trading at 10,352. Okay, let's bring the chart up a little higher so you can see what I'm talking about. Okay, there's the high, 11,623. Tried to get back up to it, failed. Tried to get up to it, failed. Didn't even get anywhere near it, and now it looks like it might be rolling over, down 60 today after being as high as 10,492. You see, it doesn't like that 10.5 area. See, you start closing above 10.5, that would be constructive. So keep an eye on the transports. You want to see a little more of a confirmation? Then try to see it close above 10.5. Russell, RUT. $2,000 stocks, mostly local, into the U.S. and small cap. There's your high at 1742. There's nowhere near it. There's a high nowhere near it. And here's a high nowhere near it. And today it was down 13. So again, what am I saying? I'm saying that we had a rally to new highs, but it really wasn't much of a new high. And the second thing we had is we had the Fed's going to keep lowering interest rates. And we had gold take off. And something doesn't make sense here out of those three things all happening at the same time. So the bottom line is that I'm thinking that you got to keep your eye open, and you've got to see if we're going to get a bit of a rollover. So use that line in the sand of this week's high on the S&P, and then if it starts to take out the weekly low, then of course that would be an indication that maybe this thing is going to have a correction, and maybe people got a little bit too excited. Again, my sell zone, which I've been talking about, the low end was 29.50, which is the former high, ballpark, plus or minus a few points. We're not going to, squeeze the eagle until it screams, somewhere around 29.50, and then up to 3,100. So if we get an overshoot, I think 3,100 is about as far as it's going to go on this little run. If it gets some kind of a news that would be very stimulative, and get every Tom, Dick, and Harry to cover if they haven't covered already, and get some of this sideline cash back in the market. Again, I have to acknowledge that the survey that I heard is, indicating that there is quite a bit of sideline money. The survey, I think, of the Bank of America survey for fund managers, equity allocations, lowest since 2009. And then cash levels soared to the biggest since 2011. Bond allocations are the highest since 2011. And a record percentage of people think the dollar might go down. All right. So having said all that, that means there is some people on the sideline. But if they don't want to take the risk of buying the all-time high in the history of mankind, they're not going to come in. Okay, because if they wouldn't buy at lower levels, are they going to buy the all-time high and just hope this is a good time to get in? Maybe. I would think that maybe the sideline money is there for a reason. So at least in part. Let's take a look at interest rates, because I'm trying to also explain to people that rates have already dropped. This is called after the fact. And what do I mean by that? The Fed's at 2.25, 2.5, right, on Fed funds. And let's take a look at the 10-year Treasury. 10-year Treasury was up at 3.25, and it dropped all the way down here. This is when he said we're going to take a pause, and it dropped all the way down here to 2. That's 125 basis points to the downside. You see that little tail there? I'd watch this week's low of 197. If they don't take that out and they start going the other way, then maybe it's a situation where it got very oversold and it might snap back up. Okay? Because again, right now, everyone is thinking it's going down to 0 interest rates. Up here, everybody thought there was 3 hikes this year. So, let's be realistic to know that the winds of change can blow at any point. And what would make the winds of change blow? Well, how about if these earnings start coming out in July and they're actually quite good? How about if the GDP number comes out and it's quite good? The likelihood of going to 0 interest if you have a 2 or better on the GDP number is pretty low. Now, again, a lot of people are saying they're comparing ourselves to Germany and Japan. Let's be real. I think we're 10 times the size of Germany and 4 or 5 times the size of Japan. So, our system is different than theirs. Secondly, we have a reserve currency, the dollar, which people use all the time. Well, they're not going to use the yen anytime soon as a reserve currency, and they're probably not going to use the euro either. So bottom line is there are some unique situations for the U.S. versus the other countries. So comparing them, I think, is silly. With regards to And again, it sounds to me like Trump is always complaining about the currency. Again, the president has a little bit of a loose relationship with borrowed money. Again, he's a real estate guy. Obviously, real estate people do like to use borrowed money, and the lower they can get that interest, all the better, and the more money they can get, all the better. But sometimes it doesn't work out so well being loosey goosey with money because, like in Atlantic City, if you build a bunch of casinos and borrow a whole bunch of money, and then the revenue doesn't come in, you end up defaulting on the debt, and people are left holding the bag pretty well. So again, we have to be careful, and I'm happy that Mr. Powell understands this, that you cannot be just a riverboat gambler with the nation's monetary policy. With regards to the dollar, though, let's take a look because it is deteriorating a bit, and let's see if it looks like it might be ready to pop. I've been telling you the range is 95, 96 on the bottom, 98 or so on the top, and it's still in the range, but it's at the bottom end of the range. And yes, it does look like it's coming down. This also corresponds to a gold price that closed above 1400, which I'll show you in a second. But what I'm trying to say here is on the big picture, it has not broken under the 95, 96 area with any kind of certainty, but it certainly does look like it's trying to do that. Now, if we break under the 95 and then the 94 area, a longer term graph would show you that it could rapidly drop. And that's where people who are thinking we're going to drop 5 or 10% on the dollar are getting their information. Let me do this for you real quick and show you a 10-year graph, and that'll show you what the dollar has done in the last 10 years. And there it is. Now you can see that there is risk to the dollar because, if it breaks under 95, like I said, there's nothing under here really that'll hold it till around 90. And that's your 5% move, right? Now, if you break under 90, there's not much under there to these highs of 85. There's your 10% move. So the people that are looking for a 5 or 10% move think it may have started this week, and they are looking for this 95 to get taken out, and they are looking for 90 ultimately to get taken out as well over time. We'll have to see if that's the case. It certainly could be the case. Follow the numbers, but right now it's only at the bottom of the trading range. And so you have to be careful that it doesn't break the bottom and then circumstances change to make it go back up. But clearly, you're very close, like they say, you're very close to the line in the sand. So monitoring it closely right now makes a lot of sense. With regards to individual stocks here, where people were hiding, they were hiding out in real estate. And so let's look at the Vanguard Real Estate Trusts. Again, there's many trusts out there. This is one of them. And you can see that today, anyway, it did roll over just a little bit. It went down to 90.23, and it made a high, I think, this week of 91.85. Not too much of a turn. And the utilities are still fairly firm. So there hasn't been any big change, which also might be telling you that it's really not a risk-on thing because REITs and utilities are not exactly riverboat gambler sectors. You know what I mean? So let's see what is going on, and let's look at the FANG stocks. We'll start at Facebook and see if they're telling us anything. Now, Facebook has this new currency they're trying to come out of, the crypto situation, and obviously there's going to be some stumbles along that, but it is making people think that this thing could make a run to its high of 218. So again, obviously we're up today. If it can take out 200, going up to make a new high at around 220 is certainly possible, if not probable at that point. But again, 200 is still your point that you haven't gotten above. Today you were at 192. Let's see what it does next week. But 200 above that would open up the door for the 225. Okay, the other one is going to be Amazon. And Amazon right now is down a little bit. And again, this is a company also with Amazon Web Services, which is a huge company. But again, it does have some resistance here around 2000 and then 1900 where we are now, 1950. So, you got a pretty good defined thing. If we break above 2000, it could very well get off on the bicycle again. And if it takes out this reaction low around 1700 or so, that would put it on the defensive. So right now, it's still in the middle of a trading range there, pressing closer to the top end. But we'll have to see what next week brings and see if, in fact, they will get this thing to get going further. Okay, let's take a look at Google. We'll go to Netflix first. And Netflix is up for today. Again, that is a company that just seems to get subscribers and subscribers, and they figured out how to raise prices a little bit, so that's helping them quite a bit because they were very, very cheap, and now they're kind of nickel and diming people, moving the rate up a little bit, and that's helpful to them. This 350 number looks like a pretty big area of support, so that's pretty much where you want to stay above, and getting above the high point here and around the 380, 390 area would open up the door to take a run at that 420. Again, kind of in the middle. You got a what, 390, 380 up top, and you got about a 350, 340 under in the middle. And they're going to be announcing earnings, I'm sure, in the next quarter, and that'll probably have a big effect on what's going out. But if it starts getting above 400 again, it could open the door for some pretty good activity on the upside. Again, this is a company that people are very, very bullish on because of the fact of their subscriber base and some of their material that they have. Next one is Google. And on Google, you're looking at 1121 up 10 points, starting to make a move. Went down towards 1,000, as you can see, 970, 52-week low, and then it's been coming up ever since. Ran up to 12, almost 1,300 a couple times here. Looks like that tail there for this week might be something to trade against. And 1121. If we could start getting this thing back above 1,200, it would open the door to new highs possibly. So keep an eye on the 1,200 and 1,100 trading range here, and see if it can stay in that range or break out above, and then kind of go with the momentum that's created maybe. Much lower PE ratio on Google than many of the other ones, so that makes it somewhat interesting. Let's look at Microsoft, which is just a company that just keeps going and going and going. And basically, you're looking at 136 and up again today, but not much, pretty flat. And again, has had a big run. So, if in fact it can continue to maintain above 135, that would be great. You figure since it's in most of the ETFs, if the overall market is going to go up, that it would probably participate in the move. Some people are trying to look at some stocks that might take a move, like Cisco. What does Cisco do today? It was off a little bit. Some people are thinking that if it can get above this current area here, around 57, 58, it could open the doors to even further action. It's had a pretty good size move here, but they are thinking the valuation of 19 makes it a little bit on the cheaper side. And it does pay 2.45, according to my screen, of a dividend. Some of the oil stocks seem to have been picking up some steam. I've been looking at Royal Dutch Shell because it pays such a good dividend. And basically, Royal Dutch is up again today a little bit, but look at the dividend, just under 5%. PE ratio doesn't look too scary, and it does look like it's trying to make a turn here. If we can get above this 65, 67 area, it opens the door to make a run up here. So if oil is going to go back on the bicycle, this would be something to keep an eye on. Another one that pays pretty good is British Petroleum, and take a look at it. BP, let's go to a 1-year graph here, go back into a little tighter time frame here. And it's up today, and it pays 575, just a shade under 6. So I noticed those yields. Actually, earlier the week, Royal Dutch was paying 5%. This was paying 6. So that caught my eye, and of course somebody else's eye either, because you can see it's gone from 40 to 42.5 this week, which is not too shabby. Again, if you're going to see oil continue, you would imagine these are some of the companies that might benefit from it. The other situation here is Apple, and it's been pressing up against that 200 number, and it'll be interesting to see if it can break through. One thing people have to remember is that the stock market, for all its great talk this year, because don't forget, you started the year with a very low bar, 2,400 or so was where we started the year, 2,450, whatever. So that was after a collapse in December. So of course the numbers this year off of the lows of January are going to look good. But the reality is this thing hasn't made a new high in a long time, and 233 was the high, and there's another high here at around 215, and this thing here is having some trouble at 200, which is not surprising because there's lows right there. So if this thing rolls over to the downside, you might want to be careful as far as protecting yourself. One way to hedge yourself, there's a few ways to hedge, more than one. One way is to buy some married puts, where if you have some kind of a 30-point gain, you might want to put $5 into puts just in case it's going to go back down. Second thing is you can look at collar strategies where you sell the out of the money call, say at 210, and buy the 190 put using the premium from the 210. And that gives you a range and a lock-in period of 210 on the upside and 190 on the downside, depending upon how much premiums you've got. If they're offsetting each other, then you're pretty flat in between the two ranges there, as far as your upside potential to 210 and your downside risk is at 190. With regards to replacement trades, that's where you dump some shares and you replace them with call options. And if you're up $30 and you only put $5 into the call options, then if it goes into the toilet, you only lose what? The $5 premium. Whereas if you're in the stock and it takes out 170 or goes the other way, you would be at more cash risk. Although you can hold the stock until the cows come home and hope it goes back up. Again, hedging is something I'm very familiar with. If your firm isn't or you're not, and you want to go over some numbers and see what the use and the risk of the strategy is, simply shoot me an email at optionprofessor@gmail.com. OPTION, professor at gmail.com. Okay. All right. Let's see anything else that I've been following. Well, let's look at some of the banks here, because Wells Fargo went up and almost started paying 4% dividend. Now, of course, dividends can be cut, so it's nothing for sure, but that's what they were yielding earlier this week. And right now they're at 384, because like I was saying about the other ones that were yielding higher than they are now, I'm not the only guy in the world who can see that. And some people bought this to this week, apparently, because they wanted to take a shot at the bank, but also maybe get in there and get that good dividend yield. You can see there's a low at 44, and now it's trying to build. We start breaking up above 48 and 50, I think then you're back on the bicycle. Up until that point, the downside seems like it is still in the controlling phase here. Okay, and then I was looking at some of the hold on. Yeah, I was looking at a tobacco company, international, Philip Morris, PM, and they've got exposure, I understand, to cannabis as well as alcohol, all the bad things in life, I guess, or whatever you feel about that. But again, Philip Morris is paying a very good dividend, and it was up very strong today. So if you notice, people, if they're going to go back into the market, they seem to be looking a little bit towards the dividend stocks, and that may continue because, again, people are going to feel like, well, if it goes down, at least I get a dividend, right? So this one here, has tried to pop up here today. There's your 75 low. So again, getting above 80 would be nice, of 85, and then of course, staying above 75 would be kind of a key there. Let's take a look at some of the high yield stuff, because spreads on high yield are just totally collapsing down to 350, which is very low. Some people are going to say they're going to 300. That means 3 points over a treasury, and the credit quality obviously is miles away. So again, today they were down a little bit, went up, went down. They've had a pretty big run though. I mean, come on, this is high yield. It's also known as junk bonds, and they've gone from 79 to 88. Plus, they're paying what? A pretty reasonable yield. So again, this is part of the over enthusiasm that I think might be going on here, in that people that have very questionable covenants on their issuance are possibly being able to issue bonds in a situation where people are not looking at the credit quality because they're what they call stretching or reaching for yield. You got to be careful when you reach for yield, because as you can see here, you're reaching for yield, and if anything happens, that would cause people to think things might tighten up, this thing can go down just as fast as it goes up, because again, sometimes liquidity in this stuff is not the greatest. And so again, right now the liquidity is great because we're on the all-time high on stocks, and everyone's saying the Fed's definitely going to cut, and maybe they'll go to zero and all kinds of stuff like that. And that makes these yields that you're looking at here very attractive, and they could care less sometimes, or some people anyway, could care less with who's issuing it, as long as they can get that yield in their mind. Again, that kind of yield comes with a risk, and you got to remember that. All right, let's take a look over at the gold. And I've been showing you the gold shares on the GDX for quite a long time. Let's see what happened here today. Pretty steady, pretty steady. It's trying to break out. I'm a little concerned that it's that it's extended here because it's up 20% in about a month or 3 weeks, right? So, I thought, the correction would take us down to 20, which it did. And I thought there'd be some resistance at 22, popped above that, and then resistance at the highest 23. So we're above all that. I would say, the way it looks right now, and this is a very high volume, though. And sometimes high volume comes at a turning point. Like there is high volume here, and it was a turning point there. There's high volume here, still made a little bit of a low, but then it started to turn up. Right now, you have a very high volume here, about as high as it's been. So again, on a short-term basis, could it pull back? It could pull back. Okay, but again, there's a lot of people plowing into this market, and again, it could be a situation where it just keeps going. Because it is coming in out of a lower level. If you look at a 10-year graph on this stuff, there's room to move. Some people are thinking that silver might be the way to go because it has not gone so far so fast. So let's take a look at silver and see if there's any merit to that. Yeah, silver's at 1436. It's not doing much, but it had gone up a little bit from the low. But can you see it's really lagging? Let's take a look here. Yeah, you see it tried to break out, but it's kind of like being drug up by something else, which is not always the best way to go. Looking at the moving averages, let's take a look at the moving averages on silver to give us some gauge. Has the trend turned up? And where would the moving averages be at now? Yeah, well, they haven't really turned yet. The market's above the moving averages. That's great. But again, you'd like to see the 50-day above the 200-day, and that would give you a better idea that the trend of price has turned up. Right now, the longer you stay above 1360, the longer you stay above 1390, the more chance that these moving averages will turn up, and maybe the future could be a little bit on the bright side for silver. But certainly it is lagged. Now, it might have lagged for a good reason, and it might be lagging because gold is not going to sustain its price. I don't know. Time will tell. But I do know the longer it stays above 1360 and 1390, the better. And when these things invert, and if this thing can get above $15, 15.50, that would open the door to getting to these highs of 16, 17, and then above that. So if gold is going to do what some of these people said, Paul Tudor Jones is looking for a move up to 1700 possibly, but it might be a longer term, 1 or 2 years. But the bottom line is if we're going to go up into that region, you would think that the silver may go up as well. But the gold to silver ratio is in the 90 area, and I've been in this game a long time. It used to be 30-40 for many, many years. And going to 90 is telling me something has changed in the silver market, like it has changed in the platinum market, because platinum always used to trade at a premium to gold, and now it's trading at a $500 or $600 discount or something like that, which is enormous in my view. So things change, right? Things change. Automation changes. Maybe they're not using it as much. Maybe people aren't interested in these metals like they used to be because they can do ETFs, because they can do different types of gold shares in lieu of buying the coins. So again, things change all the time, but the bottom line is keep an eye on it. It is breaking out on the gold. Let's see if it can hold its water. Next week, like I tell you, is a big week. Again, you've got the Fed governors talking in the early part of the week. You've got the G20 at the end of the week. You got the market in with RSIs up in the 90s, and so it can be a situation where the volatility could pick up significantly. Again, you are looking at the best June since 1938. You can see it right there on the screen. It's on track for that. Again, next week could be a whole different ball game, but that's a huge number. I mean, 1938 is a long time ago, right? 90 years or something like that. Or 80 years, and that's a long time. So that means you're looking at something fairly historic here. And again, if temperatures come down a bit, it may have a correction. So keep an eye on it. Again, closes above 2980, real positive for the market. Going up towards 3100 is about as far as I could see it going. But of course, I'll monitor it week to week, and you have to be flexible in here. If you get stuck in an opinion, you can't fight the tape and you can't fight the Fed. So don't forget that. All right, I'm going to sign off. I'm Jim Kinney. I'll be back with you next week. That's the 28th of June. Until then, good luck and good trading. Remember to tell your friends. If they want to get an update on this, just go to the website, optionprofessor@gmail.com, OPTIONPROFESSOR.com, and get the link. And secondarily, if you have any questions on anything that I've talked about or anything that you're involved in that you'd like to talk to me about, simply shoot me an email, optionprofessor@gmail.com. Okay, big week this week. Another one coming right up. So have a great weekend, get some rest, and I'll be back with you next Friday. Good luck, everybody.